So a day like tomorrow, how does it impact somebody like you who obviously manages for the longer term but can't ignore the macro trends?
Yeah, so I mean, tomorrow's a day we're going to be watching a lot, but I can tell you generally we're not expecting a big reaction in the marketplace. So, I think on par, we think May is going to pull it out. We think the ECB is going to continue to be accommodative, and we just don't think a lot is going to come out of the Comey testimony. So we'll be watching it carefully, but I wouldn't expect to see a big reaction in the marketplace tomorrow.
So for your division, has anything really changed since the election and since even the Brexit vote? Are all those long-term trends still in place?
I think one trend that people are really missing is what's happening really underneath the current in markets today. And by that, what I mean is, we've tended to see these very low volatility levels in the market overall. I mean, as you see, the VIX trading at sub 10. But underneath that low volatility level, what we're seeing is really an increase in dispersion. So stocks are really starting to act quite differently. And that presents huge opportunities for us as an active manager. And maybe just to give you a sense of just how significant that shift has been, if we look back to 2012, we saw pairwise stock correlations at 0.65. In the first quarter of this year, they're averaging about 0.2. So really a massive decrease in correlation. And again, that presents opportunities for active managers to buy certain stocks and not own others.
But for good ones, and it seems to be more and more difficult for the better managers to sort of make their mark for generating alpha?
Well, I think you're right. If we look at 2016, what we found was only 20% of managers in the large cap space outperformed. But again, an interesting sort of snippet from our own franchise is that we're seeing, about 74% of all of our active strategies outperforming the market year to date by substantive amounts. So on average, asset weighted, we're looking at outperformance through the beginning of June of approximately 185 basis points.
So we're going to pull up a chart right now showing active versus passive, and it's clear that investors are still, interested in both strategies, but passive is on the receiving end of these outflows. Look at the last 12 months of outflows for active mutual funds. Now, it's volatile. These change month by month, but, where do you see that trend going?
Well, I think you're picking up on a very substantive trend here, right? And we could actually extend that back for many years, right? So if we look post-crisis, we've seen, the index share of the marketplace go from about 15% to about 35% today. So, it really is a huge shift, a monumental shift into passive investing. I think part of that is cyclical, but I think part of it is structural. So I think we're going to continue to see flows into actives, but I would project that you're going to see some turnaround in those flows as the performance differentials actually evidence themselves in this new cycle.
Now you manage almost $500 billion.
We do.
Like $500 billion. That's desperate for yield in a time where you're lucky if even high yield generates 2 or 3%. Where are you going for it, and are you dipping more into the alternative space?
Well, there are a couple of places that I think are really interesting. I mean, one of the places that a lot of our managers like today is China in the emerging market space. And I think that's definitely a place that people can go for returns and yields. And I think it's a long-term play with durability, which is one of the reasons that I like it. It really is about the maturation of the Chinese economy and the Chinese market actually taking its rightful place really in the global sphere. So that's certainly a thing that we like. Another thing that I think investors can always look for is ways to play structural alpha. So one of the things that we don't talk about very often is closed-end funds. Closed-end funds often trade at a discount, and it presents an opportunity for investors to actually get into markets at a more attractive price, even when they're trading at very strong valuations.
It's funny though, because everywhere you look, you just seem to see the heaping praise onto passive funds, even Warren Buffett, most recently talking about the Vanguard this and Vanguard that. How difficult is it to keep the money that you have under management right now?
Well, I mean, I think we've, been fortunate that we have a very diversified book of business across a number of asset classes. We don't just run fundamental active money. We also run quantitative money. So, our flows have generally been, across the board, fairly strong. Again, most of those flows actually geared to fixed income and out of equities, consistent with the chart that you showed earlier. But again, I think we're at an inflection point. I think investors are going to start to recognize the value of active management. They're going to want the kind of insurance protection that active management provides in difficult markets. And I think we're going to see some change in the flow picture.
Talk to us a little bit about individuals. So, you know, the 401ks, not the big wealth that you're managing for families or what have you, but the person who's just managing for retirement, and how that's changing as millennials grow into, you know, 401k accounts.
Yeah, well, I mean, one of the great things for millennials is that these accounts are really now set up for success. So if you think about when you and I entered the workforce, we had to make a lot of active decisions to be successful retirement investors. We had to decide to participate in our 401k plans. We had to decide where to put our money. That's just not the case any longer. In fact, you know, many plans in the United States are now auto-enrolling participants. They're placing them automatically into well-diversified, age-appropriate solutions. So I think it's a lot easier to be a 401k investor today than it was in the past. So I think
except
millennials.
For the return part.
Well, the return part is challenging, but I think that there are, you know, ways to combat that, again, through, you know, well-diversified portfolios. I think the bigger challenge is, you know, what do we do about baby boomers? What do we do about people who are reaching retirement today who haven't really adequately saved or prepared?